When people hear the oil market, it sounds like one giant global price tag for one thing called oil, but that is not really how it works. The oil market is actually a layered system made up of physical barrels, shipping routes, storage tanks, refineries, product markets, benchmark prices, futures contracts, and a constant fight between supply, demand, and risk. And if you understand those layers, you understand why one headline can move prices in minutes, while other changes take weeks or months to show up at the pump. The U.S. Energy Information Administration says crude oil prices are shaped by a dynamic interplay of physical market dynamics and trading and finance. And it highlights 7 major drivers: spot prices, supply from OPEC and non-OPEC producers, inventories, financial markets, and demand in both OECD and non-OECD economies. Start with the physical side. Oil begins as a raw commodity pulled out of the ground. Producers drill it, gather it, and move it through pipelines, ports, and tankers. But crude oil is not the final product most people use. It has to be refined into things like gasoline, diesel, jet fuel, heating oil, and petrochemical feeds. The EIA's weekly petroleum reporting treats the market exactly that way. It tracks crude oil and petroleum products through production, imports, exports, refinery inputs, refinery output, and inventories. That tells you something important right away. The oil market is not just about extraction. It is about the whole chain from wells to refineries to end-use fuels. Now here is where pricing gets more interesting. There is no single universal oil price, because not all crude is the same. Different crudes vary by density, sulfur content, transport location, and how easy they are to refine, so the market uses benchmarks. EIA says the 3 most significant crude benchmarks are Brent, West Texas Intermediate, or WTI, and Dubai Oman. Brent is the most widely used global benchmark and is used to price many crudes traded in Europe, Africa, and parts of Asia. WTI is the key U.S. benchmark priced at Cushing, Oklahoma. Dubai Oman is especially important for Middle Eastern crude exported into Asia. Other crudes are usually priced at a premium or discount relative to one of those benchmarks depending on quality, location, and market conditions. That is why the oil market is really a market of differentials as much as flat prices. The headline might say Brent is $97 a barrel. But an actual cargo of crude may trade above or below that depending on how desirable it is and where it is needed. That matters a lot in stressed markets. Reuters reported this week that while Brent futures fell sharply after the U.S.-Iran ceasefire announcement, physical markets remained badly strained, with Saudi Aramco lifting official selling prices for May cargoes and some Asian refiners facing effective costs close to $150 a barrel for Arab Light. In other words, the benchmark price can move one way while actual near-term cargoes in the real world stay brutally tight. And that brings us to the second layer, the paper market. Oil is not just traded physically, it is traded financially through futures and options. CME describes WTI crude oil futures as the world's most liquid crude oil contract, used both to hedge against adverse price moves and to speculate on where oil prices are going. ICE says around half of the world's oil futures are traded on its platform, and that up to 2/3 of the world's oil is priced relative to the Brent complex. So when you hear about oil prices moving instantly, that usually means benchmark futures are repricing first, because they are the fastest place where global expectations get expressed. This is where a lot of people get confused. The paper market is not fake. It is the market where producers, refiners, airlines, shipping firms, and investors transfer price risk. If an airline thinks jet fuel prices are going to rise, it may hedge. If a producer worries oil prices are going to fall, it may hedge. Speculators also participate, trying to profit from moves in price. That financial layer can make oil look volatile, but it also helps set benchmark prices and provide liquidity. The EIA explicitly includes financial markets as one of the major forces that influence crude prices, right alongside physical supply, demand, and inventories. Then there is inventories, which are basically the market's shock absorber. If supply suddenly drops but inventories are high, the world has a buffer. If inventories are already low, the same disruption causes a much bigger panic. EIA lists inventories directly as one of the 7 major price drivers, because they are the cushion between supply and demand. That is why oil markets are obsessed not just with production numbers, but with stock draws and stock builds. A market can look balanced on paper and still spike if traders think inventories are being drained too quickly. Another huge factor is OPEC, and especially spare capacity. EIA defines spare capacity as production that can be brought online within 30 days and sustained for at least 90 days. And it notes that OPEC countries collectively hold almost all of the world's spare oil production capacity. That matters because spare capacity is the market's emergency backup. If OPEC has a lot of unused capacity, traders feel there is a cushion. If spare capacity is low, prices carry a higher risk premium because the system has less ability to respond to shocks. EIA says oil prices tend to incorporate a rising risk premium when OPEC spare capacity is low. And this is exactly where the modern story comes in. In 2026, the market has been dominated by the conflict involving Iran and the disruption around the Strait of Hormuz, one of the most important oil choke points in the world. Reuters reported that prior to the conflict, about 20% of the world's crude oil, refined products, and LNG moved through the strait. When that flow was disrupted, prices surged, and Reuters reported that the world lost as much as 12 to 15 million barrels per day at the peak of the disruption. Even after the 2-week ceasefire, Reuters reported that the physical market remained under stress and that reopening the strait would not instantly normalize flows because shipping backlogs, insurance costs, and damaged infrastructure would keep supply chains strained. You can actually see the oil market working in real time through that episode. When the ceasefire was announced, futures collapsed because the market immediately repriced the odds of a catastrophic long-duration supply shock. Reuters reported that Brent fell more than 13% on April 7th, dropping below $95 a barrel. But by April 9th, prices had rebounded toward $97 because traders were no longer pricing pure panic. But they still did not trust the situation to be stable. Reuters reported that doubts about safe passage, continued regional tensions, and the prospect of Iranian control or tolling through Hormuz kept prices supported. That is the oil market in one sentence. It is not pricing what happened yesterday, it is pricing what the market thinks supply conditions will look like next. Meanwhile, policymakers and producers react. Reuters reported that OPEC Plus agreed to raise quotas by 206,000 barrels per day for May, but also said that increase was mostly academic, while Hormuz disruptions persisted. That shows another important truth about the market: not all supply is equally useful. Barrels on paper are not the same as barrels that can actually reach buyers. A producer can have quota room, but if infrastructure is damaged or tankers cannot move safely, those extra barrels do not solve the immediate problem. And over all of this sits demand. EIA's April outlook says it now expects Brent to average $96 a barrel in 2026, peaking around $115 in the second quarter. Assuming the conflict does not persist past April and flows through Hormuz gradually resume. EIA also cut its 2026 global oil demand growth assumption to 0.6 million barrels per day because higher prices, shortages, and conservation measures are already starting to affect consumption, especially in Asia. That is another core feature of the oil market. Very high prices eventually destroy demand. The market is always balancing two forces at once: how much oil the world can supply, and how much pain consumers and economies can absorb. So if you want the cleanest possible explanation, here it is. The oil market works by connecting physical crude production, shipping, storage, refining, and fuel demand to a global pricing system built around benchmarks like Brent and WTI. Those physical barrels are constantly revalued through futures markets, where companies hedge and traders express views on future supply and demand. Prices rise when supply looks tight, inventories shrink, spare capacity is limited, or geopolitics threatens key routes like Hormuz. Prices fall when demand weakens, inventories build, or supply risks ease. And modern events show this perfectly. In 2026, the Iran conflict, the partial ceasefire, and the uncertainty over Hormuz all moved oil not because the market is irrational, but because the oil market is a giant machine for pricing global energy risk in real time.